Welcome back. Did you know that the wealthy keep nearly 60% of their wealth tied up in real estate? Have you ever wondered why? Well, we're going to explore that a little bit today, and we're going to be talking about the role of real estate limited partnerships in a diversified portfolio. But one of the things that we found interesting is that the OECD said the top 5% of people holding wealth in the world control nearly 72% of the world's wealth. And if the wealthy put nearly 60% of their wealth in real estate, it means that people in the top 5% must have good exposure to real estate. But to dig a little bit further, it's interesting to note that the top 5% is not as big of a number as you would think. You're in the top 5% if you have a net worth greater than $1 million. That means as an accredited investor, you are automatically in the top 5% of the world's wealthy. And that means you probably already have exposure to real estate on some level. But the role of real estate limited partnerships in a diversified portfolio is an important one. Number one, you get capital preservation. Real estate is a store of value. It is a physical thing, which is number two. You have a physical asset. So you have a store of value that generally goes up over time because land is scarce, resources are scarce. And so if you were buying in good locations, the value of your asset tends to increase over time. With a physical asset, it may depreciate and deteriorate over time, but there's also the ability to improve upon that asset. A third goal, and why investing in real estate limited partnerships is important for your diversification strategy, is cost basis. So if you can buy a building on a per square foot or a per square meter basis, lessen the cost of construction, you're doing well. In fact, one building that we're looking at right now, you actually are buying the entire building and 9 years of income for the land value, which is just staggering. And so you're getting a building that's 100,000 square feet plus 9 years of income essentially for free, which I don't know any other asset class where you have the potential to do that. The fourth thing that we look at, and that's important with real estate limited partnerships in your diversification strategy, is current cash flow. Real estate limited partnerships provide current cash flow. It's like a dividend in the equivalent terms for stocks. So if you get current cash flow on a monthly or quarterly basis, you have the ability to add to your net worth solely through cash flow. And that's a nice thing to have because not only do you have a physical asset, but you also have income coming off of it on a monthly or quarterly basis. The fifth area that we look at related to real estate limited partnerships is that there's upside potential. There's the ability to improve upon the asset, either the financial operations of the asset by increasing rents to market, or by maintaining or containing expenses, thereby giving you the ability to increase your net operating income, which effectively hits your bottom line and increases your cash on cash return. You can also improve upon the exteriors of properties, you can improve upon the interiors of properties, bringing them up to modern standards. And there, typically, you have the chance to increase the rents over time by making those physical improvements as well. There are four ways that we look at building diversification through real estate limited partnerships. The first one is through asset type. Guardrail Finance doesn't believe in just focusing on one asset type. We look at getting investments in a broad spectrum of assets. We are heavily concentrated in multifamily, but we're also heavily concentrated in commercial. And in commercial, we have multiple asset types within commercial. We have retail properties, office properties, industrial properties, even hospitality properties, and some student housing and assisted living facilities. So we believe that getting asset type diversification is extremely important for real estate limited partnership investors. A second thing that we look for is getting geographic diversification. Not every economy in every submarket performs the same. So we look at factors that are driving job growth and in-migration, and looking at companies that are driving the economy. We also try to follow where those companies are going and look at investment opportunities in those particular markets. A third way that we believe that diversification and getting diversification is important with real estate limited partnerships is with multiple sponsors. Guardrail Finance is a sponsor of real estate limited partnerships, but we don't only invest with ourselves. That would go against one of our theses and our investment decision criteria. Getting diversification means not only diversifying with yourself, it means diversifying with other sponsors as well. I'm invested in over 60 limited partnerships. I control some of those limited partnerships, and I also have other sponsors that I invest with that control other limited partnerships that I've invested in. But through those other sponsors, I get things that I don't focus on. It might be a different asset type, or it might be an asset type that I like, that I invest in a different market that I don't know that well or I don't have a team in. Or it may just be getting exposure to a certain economy that I don't have enough exposure to. The Northeast of the United States, or having more exposure in the Midwest, or having some exposure in the mountain states. I look at different things and where I'm invested currently, and I try to make decisions based on good sponsors, good assets, and geography. The fourth area that we look at as a group, and individually for me personally, I am a big believer of investing outside of your home market. And part of the reason is you get asset type diversification, geographic diversification, sponsor diversification, and economic diversification all in one. So I've invested in 10 countries in the past, including the United States. I'm currently invested in 9 countries, and I have exposure to 5 or 6 currencies at the moment. So that exposure, while I don't need anything beyond euros and dollars for the majority of my business, I do like to have exposure to some other currencies in markets that I like. There are 7 benefits that I look at related to real estate limited partnerships and why it's important to have real estate limited partnerships as part of your diversification strategy. One of the first ones is tax advantages. So with real estate limited partnerships, you get a preferred return or a dividend, and that is taxed at ordinary income levels. However, in the beginning years in particular, you also get depreciation, and the depreciation oftentimes can shelter the current income, thereby reducing your tax bill or negating it for that particular property. But it's very interesting that you have that ability. A secondary factor of taxes is that you do have the advantage. Once the property sells, the sponsor can decide to defer taxes and invest in a 1031, which means you invest in a like-kind property, an investment property, so you can defer your taxes even longer. Not every sponsor does 1031 exchanges or offers those, but it is an interesting avenue and it's one that's worth exploring. I don't always invest in 1031s when I'm investing with real estate limited partnerships. A lot of times I will take the opportunity to cash out and I'll go find my own investment that I think is a better opportunity. And the reason being is that sometimes when you're making a 1031 decision, you're not always buying the best property. Oftentimes you are buying a property because you want to defer capital gains. And that's not always the best decision in my mind, but 1031s I think are hugely important for long-term wealth building because it automatically increases your net worth for the time being, and you get to defer those taxes into the future nearly indefinitely until you sell the next property. A second benefit for investing in real estate limited partnerships that's tied to taxes are opportunity zones. In 2017, the US made some tax code changes and they created these vehicles called opportunity zones. And opportunity zones are effectively areas where the US government has identified a need for investment. And with that need for investment in these markets and these properties, you can defer or negate your taxes depending on the length of time that you are holding that property. And so these opportunity zones are generally in areas that are developing, or they are in major markets in kind of sub-markets within that market that need some investment dollars. And so there are websites that are available that discuss opportunity zones in full. We're going to be talking about opportunity zones in another video, but know that that is a vehicle that you can invest in real estate limited partnerships. I've done 2 so far, one in San Antonio, Texas, and I did one in Detroit, Michigan. And both of those projects are development deals. Both of those are going to be long-term holds, 10 years, and that will help us negate our taxes over time. And it's an interesting avenue to explore because opportunity zones now are in all the states and the territories. And so there are opportunity zones in every single market in the US that you can explore. A third benefit of investing in real estate limited partnerships is that they are generally not correlated to the financial markets. So they are not correlated to the stock market directly. It is more of an economic decision, and so while the stock market is impacted by the economy, real estate is also impacted by the economy. So there are fluctuations, but you don't have the big ups and downs generally in real estate that you can have in stock prices. And so real estate generally can be that store of value, that physical asset that can be improved upon. And if you're in a good location with good tenancy, oftentimes your value can be increasing even if the stock market is taking a dip. And so it's nice to have an asset class that is not directly correlated with the financial markets. In my opinion, the fourth benefit is probably the most important benefit for being able to invest in real estate limited partnerships. And that's the fact that you can invest smaller amounts of money into deals. That means that you can sprinkle your net worth around into multiple asset types, in multiple geographies, with multiple sponsors, and be able to get a level of diversification with your real estate investing that you might not otherwise be able to get if you were solely investing on your own. An example of this is if you were looking to buy a property that is $10 million, you would have to put at a minimum $3 million into that property to close the transaction, assuming you get 70% of debt. On a real estate limited partnership, let's use the same example. The sponsor is buying a $10 million property, raising $3 million of equity, and getting a $7 million loan. With that $3 million of equity, you could become part of the transaction. So if you invested $50,000 into that deal, you would only be a piece of that transaction, and thereby you would be reducing your risk. The fifth benefit of investing in real estate limited partnerships are the returns. So generally with your investment dollars, you can assume that you're going to be getting a preferred return in the 5 to 8% range, depending on the transaction, the sponsor, the geographic location, and the business plan. And ultimately, you're probably going to be looking at around a 15% IRR. So a lot of deals right now are somewhere between a 10 and an 18% IRR at this moment in time. And a general rule of thumb is that a lot of the investments that you're looking for on an equity basis, historically you want to be around a 15% IRR, but oftentimes you're going to be somewhere between 10% and 18% IRR. Those are good numbers. And after 5 years, if you think about it, if you're getting a 15% IRR over a 5-year period, you're going to get a 1.75x equity multiple. So if you're investing $100,000 over time from cash flow and from profit, you'd be expecting to get $175,000 back on the $100,000 you invested. Your original 100 plus $75,000 of cash flow and profit. But those are good numbers. So if you can nearly double your equity every 5 years, and you continue doing this over the span of 20, 30, 40 years, you'd have the ability to double your money a number of different times. So that's an exciting opportunity with real estate limited partnerships. Now you can certainly do that on a direct basis as well, but then the next point that is a benefit of real estate limited partnerships is you work less. And the reason is that the sponsor is effectively earning their interest in the property. They are earning a promote in the operations of the property. So if they overperform, then they get a bonus effectively of the cash flow and of the profit. If the deal doesn't work out the way it's intended to, your downside is the investment capital that you put in. but your upside is all the profit that can be generated without having to do all of the day-to-day work and operations related to managing a particular asset. Another benefit of investing in real estate limited partnerships is that typically you know the management that you're investing in and you know what the expected returns are. You're also picking and choosing typically which asset that you want to be investing in. So with a REIT structure, even though it is liquid because it's publicly traded, and a real estate limited partnership is not publicly traded, the difference is that you're picking what you want to invest in. You also know the structure on the front end. You're investing in an asset. You're not investing in the company itself. You're not watching the sponsor take on a debt at the corporate level in addition to taking debt on at the asset level. You also have a say in whether you want to invest in that particular sponsor's deal. So if a sponsor has 3 investments that they're marketing, an industrial deal in Ohio, a multifamily deal in California, and an office building in Florida, you can take a look at those 3 investments and decide whether you want to invest in 1, 2, none, or all of those investments. If you invest in a REIT, the management makes the decisions about which assets they're going to be investing in. Usually they have some criteria about what types of assets that they invest in, but you don't have a say of which assets they invest in and which markets. So those are the benefits of investing in real estate limited partnerships, and let's move on and look at some of the downsides of investing in real estate limited partnerships. The first downside of investing in real estate limited partnerships is that these vehicles are illiquid. It's very difficult to buy and sell these investments. So if you decide to make an investment, a sponsor doesn't necessarily need to find a way to buy you out in the event that you need to be bought out. If you do, you can have a conversation with the sponsor, but sometimes the docs that you have signed either prohibit the sale of the limited partnership interest or make it very difficult to have that interest sold. A second downside of real estate limited partnerships is that the preferred return or the dividend is taxed at ordinary income rates. Now, depending on where you're located, those rates can be high, but like I said, the offset to the ordinary income tax is that you also have depreciation at the property level, and oftentimes that will shelter the income that's generated before it's distributed. So you could have cash flow that is coming in where you've got positive after debt cash flow and a good return on investment that is on a tax basis either neutral or negative, thereby sheltering any income taxes that you may have to pay to the US. A third downside with real estate limited partnerships, which I personally don't think is as big of a deal, but it still is a downside, is that you don't have the choice of whether you want to do a tax deferral through a 1031 exchange. Sponsors make those decisions. For me, doing a 1031 is important. I've done a number of them in my life on direct investments and also indirect investments. But oftentimes when I am investing in a property that is a real estate limited partnership, I want that transaction to be clean. I know that I'm going to have a capital gains at the end, and I know that my profits are going to be treated on a capital gains basis. So at this moment in time, I'm not as worried about it when you have capital gains rates that are in the 15 to 20% range, and that is less of a decision criteria for me. More of a decision criteria is being able to find the next investment that I want to invest in. And with a 1031, sometimes you are under the gun to make a decision quickly about the property that you want to invest in, and it might not always be the optimal property for you and your investors. In conclusion, there are a lot of different pros and cons related to real estate limited partnerships. The benefits definitely outweigh the downsides related to real estate limited partnerships, and you need to have real estate limited partnerships as a diversification strategy for you in your portfolio. For me in particular, I've invested in well over 60 transactions. I've sold about a dozen of those transactions that are real estate limited partnerships, and I have not lost any money on any of those transactions to date. There's 2 deals that I've broken even on, and there is 1 deal essentially broken even, and there is 1 deal that is in litigation right now because the sponsors of the transaction actually were committing fraud and it wasn't known at the time that they were doing that. So out of all the transactions, I haven't lost any money at this point. I have been very happy with the sponsors I've been working with. I have done due diligence on the sponsors. I've done due diligence on the property. I have looked at the cash flow and said, what's my downside risk if I do this deal? What's my upside potential if I do this deal? And then I look at what the risks are involved. And then I make a decision pretty quickly, go or no go, on making the investment. But for me, having a diversified real estate limited partnership portfolio is much more important to me than maybe having one or two deals that might not go the way I intend over time. I've had plenty of those with stocks, and I prefer real estate, one, because it's a physical asset, it creates current cash flow, and it's got upside potential. So please do definitely look at real estate limited partnerships in your portfolio. Make sure that you're diversified and make sure that you're looking at getting asset type diversification, geographic diversification, sponsor diversification, and if you're so inclined, looking outside your home country, because there are significant opportunities to invest in real estate and also debt instruments outside of your home market. Thanks so much. Until next time, let's keep growing our cash flow and net worth together, and I look forward to seeing you on the next video. Feel free to like, share, comment below, and we'll get back to you as well.